Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that can seem intimidating but is absolutely crucial for building long-term wealth. Investing in companies. You might be thinking, isn't that just for Wall Street pros in fancy suits? Absolutely not. With the right knowledge, anyone can start investing and make their money work for them. So, whether you're a complete beginner or just looking to sharpen your skills, stick around. We're going to break down the risks, show you how to make smart choices, and outline the steps to build a successful investment portfolio. First things first, let's get real about the risks. Investing isn't a get-rich-quick scheme. The value of stocks can go up, but it can also go down. This is called market risk. Sometimes the entire stock market takes a downturn due to economic events, and even the best companies can see their share prices fall. Then there's company-specific risk. A company might face a new competitor, a product might fail, or management could make a poor decision. These things can directly impact its stock price, independent of the broader market. And let us not forget inflation risk. The danger that your investment returns, keep up with the rising cost of living, meaning your money actually loses purchasing power over time. Understanding these risks isn't meant to scare you. It's the first step to managing them effectively. Acknowledging that losses are a possibility is what separates a smart investor from a gambler. So, how do we navigate these risks and start making smart choices? It all begins with research, or what we call due diligence. Don't just invest in a company because you like their products or you saw a flashy headline. You need to become a bit of a detective. Start by understanding the company's business model. How do they actually make money? Is it a subscription service, selling physical products, advertising? Is their revenue stream sustainable and likely to grow? Look at their financial health. You don't need to be a certified accountant. But you should learn to read basic financial statements like the income statement, balance sheet, and cash flow statement. These documents tell you the story of the company's performance. Are its revenues and profits growing? Does it have a lot of debt? Does it generate actual cash? These are critical questions to answer. Beyond the numbers, you need to look at the company's competitive advantage, often called its economic moat. What makes this company special? Does it have a powerful brand that customers trust, like Apple or Coca-Cola? Does it have a unique technology or patent that's hard to replicate? Maybe it benefits from network effects, where the service becomes more valuable as more people use it, like Facebook or Visa. Or perhaps it's a low-cost producer, able to undercut competitors on price, like Walmart. A company with a strong, durable moat is much more likely to fend off competition and deliver solid returns over the long term. A company without one is vulnerable and makes for a much riskier investment. Another key part of making smart choices is understanding valuation. Just because a company is great doesn't automatically mean its stock is a great buy. Price is what you pay. Value is what you get. You can overpay for even the best company in the world. So, how do you figure out if a stock is fairly priced? Investors use various metrics. A common one is the price-to-earnings or PE ratio, which compares the company's stock price to its earnings per share. A high PE might suggest a stock is expensive, while a low PE could indicate it's a bargain. But it's not that simple. Fast-growing tech companies often have high PE ratios, while stable, mature companies have lower ones. You have to compare a company's PE to its industry peers and its own historical average. Other metrics like the price-to-sales ratio or dividend yield can also provide valuable clues. The goal is to buy wonderful companies at a fair price, not fair companies at a wonderful price. Now that we know how to identify promising companies, let's talk about building a successful investment portfolio. The single most important concept here is diversification. You've heard the saying, don't put all your eggs in one basket, and it has never been more true than in investing. If you invest all your money in a single company and that company fails, you lose everything. But if you spread your money across 15, 20, or even more companies in different industries and geographies, the impact of one company performing poorly is cushioned by the others. Some of your stocks will go up, some will go down, but over time, a diversified portfolio is much more stable and less volatile. You can diversify across different sectors like technology, healthcare, finance, and consumer goods. You can also diversify geographically by investing in companies from different countries. A great way for beginners to achieve instant diversification is through exchange-traded funds, or ETFs. An ETF is a fund that holds a basket of stocks, often tracking a specific index like the S&P 500, which represents the 500 largest companies in the U.S. by buying just one share of an S&P 500 ETF. You instantly own a tiny piece of all 500 of those companies. This is a fantastic low-cost way to get broad market exposure and avoid the risk of picking individual stocks. You can find ETFs for almost any market, sector, or investment style you can think of, making them a powerful tool for building a diversified portfolio. Next, you need to adopt a long-term mindset. Successful investing is a marathon, not a sprint. The stock market is notoriously volatile in the short term. News headlines, economic reports, and investor sentiment can cause wild swings from day to day. If you panic and sell every time the market drops, you'll likely lock in losses and miss out on the eventual recovery. The real magic of investing happens over years and decades thanks to the power of compound growth. That's when your earnings start generating their own earnings, creating a snowball effect. So, invest with money you won't need for at least 5 years, preferably longer. This gives your investments time to ride out the bumps and grow. Think like you're a business owner, not a stock trader. And that brings us to the final piece of the puzzle: managing your emotions. Fear and greed are the two biggest enemies of the individual investor. When the market is soaring, greed kicks in, and people pile into risky stocks at high prices, fearing they'll miss out. When the market crashes, fear takes over, and people sell everything at the bottom, terrified of losing more. The key to success is to remain disciplined and stick to your plan. One of the best strategies to combat emotional decision-making is dollar-cost averaging. This means investing a fixed amount of money at regular intervals, say $200 every month, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, your fixed amount buys you more shares. This automates your investing, takes emotion out of the equation, and ensures you're buying more when stocks are on sale. So, to recap, start by understanding and respecting the risks. Then, do your homework, analyze the business, its financial health, and its competitive advantage. Learn to assess valuation to avoid overpaying. Build a diversified portfolio, perhaps using ETFs to spread your risk. Adopt a long-term mindset and let the power of compounding work for you. And finally, manage your emotions and stay disciplined, using strategies like dollar-cost averaging. Investing might seem complex, but by following these principles, you can build a solid foundation for your financial future. It's a journey of continuous learning, so stay curious, keep reading, and never stop asking questions. Thank you so much for watching. I hope this breakdown has demystified the world of investing in companies for you. If you found this video helpful, please give it a thumbs up, and do not forget to subscribe and hit that notification bell so you do not miss our future content. What are your biggest questions about investing? Let me know in the comments below. See you in the next video. One of the most important lessons in investing is understanding that a good company is not always a good investment. A company can have a strong brand, loyal customers, and an excellent product, yet still be a poor investment if its price is too high or its growth potential is limited. As an investor, you are not buying popularity or emotions. You are buying future value. A good investment usually means fair or undervalued pricing, strong potential for growth, solid financial structure, clear long-term vision. The key question is always, is this company worth the price I'm paying today? Understanding company valuation in simple terms, Valuation does not need to be complicated. Think of investing like buying a property. You would ask, how much income does it generate? Is the price reasonable compared to similar options? Does it have future growth potential? Companies work the same way. Important factors to consider. Revenue, how much money the company earns. Profit, how much it keeps after costs growth rate, how fast it is expanding market position, how strong it is against competitors. A stable company with consistent profits is often more valuable than one growing fast but unpredictably. Long-term investing versus short-term thinking. Your investment horizon shapes your entire experience. Short-term investing often focuses on quick gains, reacts to news, and creates stress. It requires constant monitoring and emotional control. Long-term investing focuses on business fundamentals, growth over time, and patience. It benefits from compounding and reduces the impact of short-term market noise. Most successful investors prefer long-term strategies because time smooths mistakes and rewards discipline. The quiet power of compounding. Compounding is when your returns begin generating additional returns. At first, progress feels slow, but over time, growth accelerates. Small, consistent gains can turn into significant results if reinvested and left untouched. The essentials of compounding: start early, stay consistent, avoid unnecessary risks. Time matters more than perfect timing. How to analyze a company without overthinking. Many people avoid investing because they believe analysis is too complex. In reality, simplicity is powerful. Ask yourself, do I understand how this company makes money? Does it solve a real problem? Is demand likely to exist in the future? Is management reliable and transparent? Are finances reasonably healthy? Most answers are positive. You are already ahead of many investors. Startups versus established companies. There are two main paths in company investing. Startups offer high growth potential and innovation, but they come with high risk and uncertainty. Many fail before reaching profitability. Established companies offer stability, proven models, and predictable income, but usually grow more slowly. Smart investors often balance both, combining growth opportunities with stability. The role of emotions in investment decisions. Fear and greed destroy more portfolios than bad analysis. Fear causes investors to sell during downturns. Greed pushes them to buy at market highs. Successful investors follow plans, not emotions. They understand that markets fluctuate, but strong businesses grow over time. Calm decision-making is a competitive advantage, building a strong investment strategy. A strategy keeps you focused and disciplined. Every strategy should define investment goals, risk tolerance, time horizon, clear rules for buying and selling. Without a strategy, every market movement feels personal and stressful. Knowing when not to invest. Sometimes the smartest move is to do nothing. Avoid investing when you don't understand the business. Financial information is unclear. Management avoids transparency. Growth depends only on hype. Not investing is also a decision, and often a wise one. A simple comparative example. Imagine two companies. One grows very fast, but carries high debt and no profits. The other grows steadily, generates cash, and manages expenses well. Beginners often choose speed. Experienced investors choose survival and consistency. Long-term success depends on durability, not excitement. Protecting capital before chasing returns. Protecting your money is more important than growing it. Capital protection includes diversification, risk limits, avoiding excessive leverage. Long-term thinking: if your capital survives, growth has time to happen. A final mindset shift. Successful investing is not about being right every time. It is about reducing mistakes, staying patient, letting businesses grow calm. Informed and disciplined investors are the ones who win over time.